future income tax that still remains. So it's 400 minus the 20 that you already realized. It's okay? Okay. So now we have the financial statements that we're being asked to do. I don't know if we want to do the whole thing. Let's just do some accounts from it, okay? Let's look at the income statement. What would I like to do? And I'll let you fill in the other ones. On the income statement, let's do cost of goods sold. How are you going to get your cost of goods sold? Okay, which is?
65 plus 53,500.
Okay, so 63,000.
65,000 plus 50.
65,000 plus 53,500 minus 200. That comes from here. Everybody sees that? Okay. Minus 200 plus 1,000 minus 15,000, which is this. Are you starting to get the hang of it? What's always going to be in cost of goods sold? Realized profits, unrealized profits, intergroup sales. Right? Okay. What else might be interesting? Let's do we have depreciation expense? We have other expenses only, am I right?
Yeah.
Okay, so let's do other expenses. That'll sort of include absolutely everything, okay? What are we going to do here? P plus S, 22,000 plus 27,000. Then what?
Depreciation expense.
Okay. So plus or minus?
Plus.
Plus what?
125.
Okay. Plus 125. And that comes from here. Everybody see that?
Another 1,000.
Pardon me?
Another 1,000 for depreciation.
Plus 1,000, which is the depreciation of the furniture and fixtures. Is the gain on sale in this account?
Well, we don't know if it's a gain or a loss.
We don't know which one it is, right? But there's no separate account. So would it go in here? I don't know. Let's leave it out. It would be, let's pretend it would be in revenues. Okay. So we'll leave it out here.
Could we do like both in the exam?
Yeah.
Put it in sales and-
Yeah.
Okay.
Yeah. If you don't have a separate account, absolutely. Just be careful. If I put it in this account, is it going to be a plus or a minus?
Plus.
It's a plus, right? It's a plus to an expense because it reduced income. Okay. If I put it into a revenue account, is it a plus or a minus? It's a minus. Okay. So that's the only thing you have to be careful of. What else?
The depreciation expense on the furniture.
Okay, but hold on. Is there a separate account for income tax expense? There is. So I could ignore income taxes. Okay. So now I'm ready. Keep going. Sorry.
The depreciation expense of 50, so minus 50.
Here. Okay. Minus 50. That's it. Okay, I think we're done. I think we're done with the income statement. That's not so interesting. Let's do retained earnings. Everybody's favorite. Let's do beginning retained earnings. And again, remember in words, what are we supposed to have? No?
All realized.
Okay, we're getting fancy now. How do we start?
Parentheses.
P plus S, right? Okay, calm yourself down and just start with what you know for sure, okay? Go with P plus S. So do we have beginning retained earnings in this problem?
57,000.
We do. So we don't, remember last class we had to calculate it? We don't have to now, okay? So 57 plus 51.5. Okay. Are you ready? Minus 37,000, which is the pre-acquisition retained earnings. Remember, that always has to be eliminated. Okay. And then again, in words, what's retained earnings always adjusted for? The fair value adjustments that have been amortized to date, and any unrealized profits that exist at that date. Okay, so you have to just find both of them. What are the fair value adjustments that have been amortized to date? Sorry? 79.50, right? Because that comes from here, plus or minus? Minus 79.50. Sorry? Minus 120, which was the unrealized profit in the beginning inventory. Minus 120.
Dividend.
No. What dividend do you want to do? The dividend they paid this year? You see, the dividend doesn't come out of beginning retained earnings. The dividend is going to have a separate line called dividends declared. I'm doing beginning retained earnings now. Anything else?
No.
Shouldn't be anything else because this one happened during the year.
Just a question, let's say the consideration included dividend declared from 2012. Is there just an this year?
No, no. I'm trying to figure out what you're asking me before I can answer that, okay? There's nothing wrong with previous retained earnings because of dividends declared. And you might say, but it is a problem because I recorded dividend revenue and you recorded dividends declared. But I want you to understand something. If it happened in previous years, my income is too high because I have dividend revenue. And your retained earnings is too low because you have dividends declared, right? But my income went to my retained earnings. So when I add P plus S, my retained earnings may be too high, but your retained earnings is too low, but when we add the two together, everything's perfectly okay. So I don't have to deal with it. I only have to deal with the dividends of this year, because for me, it's in the income statement, and for you, it's in the statement of retained earnings. But every year after, the problem nets itself out, so I don't have to deal with it. It's only this year's dividends. Was that your question? Okay. What else? So, again, I want to just see, and then to this, what would you add? You would add consolidated net income, which you would have calculated, and you would have deducted consolidated dividends. And we know the dividends should only be whose? Just the parents, right? Okay. Now again, we didn't do the adjustment, but we could have. I don't know if you need it. Do you see on this on the problem it says interim dividend paid, final dividend declared? Does everybody see that? So do you get that I'm going to have to eliminate 5,000 of dividend revenue and 5,000 of dividend declared? Does everybody see what I'm looking at? The subs dividends? 2 and 3? Yes, no? Do you also see there's a balance sheet impact? What's the balance sheet impact?
Dividend receivable and payable.
Right, there's a dividend receivable and dividend payable, but how much? Only for the 3,000 because the other one was actually paid. Does everybody see where we're looking? But you would know that the only dividends that should show up would be the dividend of the parent, which is 4,000 and 10,000, which is 14,000. Yes? Okay. So just the last thing I would do with this problem is, remember we said we could calculate ending retained earnings also. Okay, because we don't need to have done it, but I'm a little lazy. I don't really want to calculate ending retained earnings because does this problem give it to me? How come they don't give it to me in this problem? And that's interesting. I find this a fundamental problem you guys have that comes from Comp 217. Okay? Do you realize that this problem is a trial balance? Where the problem we did on Tuesday was a balance sheet. Okay? What's the primary difference between a trial balance and a balance sheet?
You haven't closed your accounts.
Sorry?
You haven't closed your accounts yet.
Right, you haven't closed your income statement accounts yet, and that's why a trial balance always has beginning retained earnings on it, and a balance sheet always has ending. So for me to get ending from this problem, what do I have to do? What? I have to calculate. I got to go through it. I got to do beginning retained earnings, add all the net income, and then deduct the dividends. That's why I say I'm lazy. I don't want to do it. Okay? You can do it. That's Comp 217. But let's just assume it's P plus S is ending retained earnings. I'm more interested in what adjustments would I make if I was doing this exact calculation, but I was doing it now at the end of the year. And if you struggle with this, just say to yourself, I'm really doing beginning retained earnings of 2014. Let's say I was asked to do the statement of 2014. It's the same thing. So I start with P plus S. What are my adjustments? Do the first one first. Minus 37,000, which is the same pre-acquisition adjustment, right? We have to make that no matter when I'm doing retained earnings. Okay? And then I'll say it in words. It's the same again. I have to adjust for fair value increments that have been written off, and I have to adjust for any unrealized profits that exist at that date. The only thing I've changed is the date. Okay? So what are the fair value adjustments that have been written off? It's not just 79.50 anymore, because one more year's gone by, so it's the 79.50 and the 1,050, which is this and this. Because 1 year later, if I was doing 2014, these adjustments would actually have been now in beginning retained earnings. Is that okay? Okay, and now I have to say, this is where it gets slightly more difficult for you. I need the unrealized profits at the end of the year. Whereas in this calculation, I did the unrealized profits at the beginning of the year. If I'm doing end, I need unrealized profits at the end. So what's unrealized at the end? Talk to me about inventory.
Well, the 120 is realized.
Yeah.
So there's not that anymore.
Right.
Yeah, 600.
600?
Yeah. The 1,000 realized.
Absolutely. Minus 600, which is the unrealized profit at the end of the year in inventory net of tax. This one's not unrealized anymore because by the end of the year it has now become realized. It's always what is unrealized at the end of the year or on that date. Talk to me about the furniture and fixtures.
950 times 60%.
Well, it was originally 100, but then you realized 50. So at the end of the year, the amount that is still unrealized is $950 net of tax, which is how much? 570? 570. Or the other way to have done it is said it's 600 minus 30, which is 570, right? Because you realized 30. And if you try to balance this on your own at home, this will work. Any questions technically? Are you comfortable? Yes? I really think that some people think the exams are hard, but I never am out to trick you, okay? Because the material is difficult enough. So as far as I'm concerned, if you can do the problems, you can do the problems, and you can get perfect. Okay? And many people do get perfect on these types of questions. Okay? I hope you can see why. Like if you get the calculation, you're going to get the whole thing. So the key is to work on your speed and to really spend time here. This is where problems start, here, and with the calculations of the unrealized profits. Let me try a case. Okay, I said I would do the one from your exam. I brought it here. Do you have the case with you? By any chance? I put it up on here. Does this look clear to you? Like, can you see this? Make it bigger? Better? Okay. You got 32 minutes to do this, okay? Strategy 1. Can I just say that when I walk around at a midterm, I notice students do the exam in order. I don't think that's a good strategy. I think you should look at an exam and you should figure out how to do it. I think personally, your choice of course, I think a case is done last, in my opinion. Okay? And a case, when I say done last, it doesn't mean that you're left with 10 minutes to do it. Okay? You've got to leave yourself at least 32 minutes. And if you're really good, you want to try to build a few minutes on each question so that you actually have more than 32 minutes to do the case. Okay? That's if you're really thinking. Because you need your brain to be able to calm down and say, this is all I have left to do, let me read it properly now, and let me see if I'm understanding. If you do it first, you're going to be already, your head is on the numbers, and keeping those formulas in your head and realizing what you have to do. And I think it really distracts from your ability to do a case. Common problems students have. Some students, it's an interesting phenomenon. In undergrad, nobody likes cases because you only like numbers. And I teach in the CA program too, and in that program, nobody likes to do numbers. They only want to do cases. Okay? So it's interesting how you switch over. And most cases actually combine both. So there's a numerical portion to an analysis, but you have to know why you're doing it and fit it into a proper context. Okay? So we start with always in a case the required, which usually is useless and takes you 2 seconds. Okay? And the required here says respond to Roger Martin's request, which means that all you know now is that you're talking to Roger Martin, right? Which really hasn't helped you. You have to find the real required in the case. Okay? So it says here the following. RMI is a private company that designs laser applications for the healthcare and electronics industry. Its head office, located in Toronto, employs 150 people. Roger Martin is the company's CEO. Okay, so now I'm getting an understanding that I'm talking to the CEO of this particular company. What's important in that sentence?
Private company.
It's private. Okay? It's important that it's private, right? Which means it's going to follow ASPE. Okay? It is August 2013, and Roger contacts you to advise him about a transaction you would like to carry out. He asks you to assess and provide input on the accounting treatments for the transactions set out in Exhibit 1. What's that paragraph telling you? You're required. There's your required. Okay? And I'm telling you, highlight it, underline it, and that's what you have to answer specifically. So you better tell them the accounting treatment for the transaction. Okay? Notice you're not in there to advise on business, whether or not he should buy it, sell it, whatever. Very interesting, but not part of the required. KRS is a company that designs fiber optics using new generation laser technology. Its products are chiefly used in telecommunications. The market is growing so rapidly that a new competitor emerges every year. KRS also has a telecommunications division, VoIP, Voice over Internet Protocol, that uses this special optical fiber. Always on the lookout for new developments in the laser market, Roger became interested in this company. After more than 4 visits to Vancouver to meet KRS's owner, Christine Region, Roger obtained the following information about the organization. Okay. So what is that paragraph telling me?
Easy combination.
Okay, maybe, okay, that this is an issue of acquiring another business. Do we get that? So we have an idea of what this case is going to be about. Okay. So then we go to KRS. And we have Exhibit 1. What's the story here? KRS signed a contract with a supplier for the raw materials used to produce the optical fibers that guarantee supply until 2020. Given the shortages of raw materials in the fiber optic field, this contract is advantageous. Under this contract, the raw materials are supplied at market price less 10%. An expert in the field values the contract at $1 million. Mean anything to you? Okay, I'm starting, my brain should be starting to work. If the topic here is possibly a business that I'm acquiring, and they're giving me values of assets, then my head is starting to think that this is perhaps a separately identifiable intangible. Yes? Okay. KRS has fiber optic plant, the fair market value of which is estimated at $650. The plant is equipped with leading edge equipment valued at $1.1 million.
Fair value.
Again, fair values. KRS also owns another building that houses its cellular telecommunication. I just realized I'm looking at something different than what's up here. The houses its cellular telecommunication division is valued at $800,000. Have any interest? Fair value again? Okay. The building also houses a sophisticated computer network with a fair value of $2.3 million. More fair values? Okay. KRS also has an exclusive patent for the manufacture of optical fibers valued at $500,000 by an independent expert. The optical fiber manufacturing division employs 50 people, while the cellular telecommunication division has a workforce of 8. Sorry? Maybe. Are you noticing now that there seems to be 2 divisions that we're talking about? Okay. Do we know why?
We only acquire one.
How do you know that? Do you know that yet?
No.
You don't actually know that yet, right? But you should start to read it and say, why is this case talking about 2 divisions? Okay. In November 2012, Christine Region expressed interest in selling KRS's assets in the optical fiber manufacturing division for a total of $5.25 million to be paid in cash in order to concentrate on his telecommunications service division. Okay, so now we know the real story. What's the division that's up for sale here? Optical fiber. So are any of the fair values that have to do with the telecommunications division relevant? No. So I'm only interested in fair values of the optical. Okay. So then I say it was decided it would be advantageous for RMI to acquire these assets since both entities are active in laser design and production. In December 2012, RMI and Christine Region signed a purchase agreement in the amount of $5.25 million, specifically covering the acquisition of the following assets: the contract for the raw material, the optical fiber manufacturing plant, the plant's equipment, and the exclusive patent for the manufacture of optic fibers. What's important here for me to understand? The deal has already been signed. The purchase agreement is signed. You should not be talking in your answer about how much should you pay. Okay, because that's a given. And remember, that's not even my required. What's my required? The accounting treatment for this transaction. Okay? So you always have to remember this. RMI decided to send 3 foremen to Vancouver to learn about and monitor the company's operations and resource processes. Roger held lengthy discussions with Christine Region about the strategic management of the manufacturing activities. In addition, KRS's manufacturing division will retain its current employees who will be paid by RMI. KRS will occupy 20% of the plant to store equipment and signed a 5-year lease to that effect. The rent is equal to the fair market value of the building's occupied surface space. The purchase price was broken down for the various assets acquired based on the fair market value as follows. Roger is proposing to record each asset acquired at the cost to him. Roger has spent $200,000 in legal fees, $150,000 in fees to obtain asset values, and $40,000 in fees to arrange financing to be able to acquire the business. Okay, and I believe that's the end of the question. Right? And you are busily starting because how long did it take you to read that of your 32 minutes? 10 minutes? I think within 10 minutes you should be able to read that. So now you have 20 minutes to write. Brilliance. Okay? And of course you're going to write in point form, right? Because writing these long stories is going to take you forever. Although some of you just can't do it because it's just not in your nature. And you need to write and write and write and write and write. Go ahead, okay? But just make sure you're saying something and you're not saying the same thing over and over again. So now, what are you going to write about?
Have the introduction first.
Okay, what would that introduction be?
Contain the required, the users.
Okay,
The role.
okay. Which are?
Oh, the user, I guess, would be the CEO, Roger.
Okay, but you have to be careful because if I'm writing to Roger, do I write to Roger, you are the user of my report? Do I write that? You might want to put it as a note at the beginning of your memo, but it should not be in your memo, okay? You are writing to Roger, so start the report.
Attention, Roger.
Okay, there's a start.
Mention the required that you're gonna be, like this memo is gonna explain the accounting treatment for your business acquisition.
Okay, I totally agree with you, except you made a fatal flaw right away. Okay, she said this memo is going to write to you about your business acquisition, the accounting treatment
For the transaction.
for the transaction. Stay vague. Don't say the business acquisition, because to be honest with you, that is the first major thing that you should have talked about. And what is that?
If it's a business or not.
Is it a business acquisition? Okay. And I can tell you on the midterm that many people didn't do that. They went right away and assumed this is a business acquisition, and all I got was a numerical analysis of the consideration transferred compared to the consideration received. Right? And an establishment of goodwill. Few marks, very little. When you look at the solution, you're going to see it's marked as an evaluation guide, like your case was that you handed in. And one of the areas of the evaluation guide is student discussed whether or not this was an acquisition of a business. So what do you have to talk about? Right, did this division have its own inputs, processes, and outputs? Because what did you buy here? Did you buy shares? Many people made that mistake, right? And started talking about consolidating. Are you gonna be consolidating here? Absolutely not, because you're acquiring assets. You're not acquiring shares. So a student who starts to talk to me about the accounting treatment being consolidation gets a big 0 now, right? You're completely off track. And some of you are smiling because that's exactly where you would have gone, right? But remember back in chapter 2, we were buying assets. Okay? So the question is, did you buy enough assets to constitute a business? And what do you want to talk about? Because the problem tells you that they specifically bought only certain things. Where was that again? They bought,
the optical fiber manufacturing plant, equipment, and exclusive patent.
right. So is that sufficient to constitute a business?
Yes.
I think yes, right? Because you have the inputs, which is the contract for the supplies. You've got the equipment, which is required to manufacture it, and therefore you have the outputs. Conclusion, you have acquired a business. That's first issue. So now that I say I've acquired a business, so what?
Since you're private, you follow ASB.
Okay. Are there any differences between ASPE and IFRS on this topic? No. So it doesn't really get you anywhere, this notion of ASPE versus IFRS.
Do we have to say that it's ASPE because a private company could follow IFRS?
Absolutely. I don't even know if there's any marks on the grid for that, because in this topic there's no difference between ASPE or IFRS. Okay. So we concluded it's a business acquisition. Now what?
Acquisition analysis.
Sorry?
Acquisition analysis.
We have to do an acquisition analysis? Why? You see, I worry that you would go right to the number now and do the acquisition analysis.
Well, I'll explain first of all why we need to distinguish if it's a business or not.
Tell me why?
Well, because if it's not a business and it's just an acquisition of a group of assets, then you have to record it at cost.
Okay.
Whereas if it's a business, you need to account for it using IFRS 3.
Which is at? Perfect. Okay, I like that. So now you're going to conclude that it's a business, and therefore the net assets have to be recorded at fair value? Did they do that?
Well, that's not what he wants to do, but.
It's not what he wants to do. If you start, and I can't tell you how few students did this on the midterm. Like it's there, and I had a few people call me over even during the exam and say, I don't understand. How come down here it says these amounts, and up there, when it talked about the real fair values, it's different amounts? Did any of you notice that as you were reading? It's not the same. Because if you go down here, and you take 1050 and 1177 and 808 and 1615, what do you think that's going to add to? The 5.25. So what they've done is they've taken the cost that they paid and allocated it to each of the net assets that they acquired. So what do you want to tell Roger? Can't do that. Because in a business acquisition, it's not based on cost, it's based on fair value. Okay? And that leads you into, okay, what is the fair value? Okay? And now you're going to list each one based on the information I have up above, that we have a valuator who said that it's X amount for this asset. It has to be recognized. Why does it have to be recognized? Because it meets the criteria of being separately identifiable. Why is it meeting that criteria? What's the criteria for separately identifiable?
It's all by itself.
It can be sold, could it?
Yeah.
Or, what's the second criteria?
It's a value. You add value.
No. What's the second criteria? That's the one he said. Okay. What's the other one? Legal or contractual right associated with it. which this certainly has, right? It's a contract. That's what I mean, you don't know the rule, you're not gonna get the mark. Okay, so you have to know how to talk about it in terms of the criteria. So you discuss that, and then your last thing you do is actually the acquisition analysis, where you put the numbers down and you say, if this is the amount I paid, and this is the fair value that you established, then this is the amount that you're gonna end up showing as goodwill. Or maybe it's not goodwill, maybe it's a bargain purchase. And that is how you tell Roger the impact that this is gonna go on your financial statements. Do you see that you knew all this? There's nothing here we talked about that you didn't know. The question becomes, how was I supposed to know to talk about that? Right? That's the hard part about a case. How do you know that this is what you have to talk about? Okay? And I'm trying to tell you in a case, go back to the beginning. You have to say it logically. Notice my process. First, is it a business acquisition? Second, what is the criteria for a business acquisition? Third, how do I meet those criteria? What is the final result? But that's a case because it's about a business acquisition. You might have a case that's about something else. Okay? Doesn't matter. Find the report required, then find within the report requirement what are the actual issues to talk about. And you need to put down your pen for 5 minutes to think about it. If you start to write right away, it will be all over the place. And that's what happened to people, is that they couldn't stop because they probably had 5 minutes left. And so they just did the acquisition analysis right away. That's not an answer to a case. Okay? You have to go through the process. You had a question? Okay. Any other questions? No? It's clear? Okay. You can reach me probably by email if you have questions till Saturday. But you won't. Everybody saw I posted the